All right, so hopefully the previous video did not go over your head, but let's get into a real chart example. I literally just went to a random trade that the indicator had called out. So in this case, this was the 10th of July. And again, we're going by liquidity targets. We want to have these marked up on the chart ahead of time. And if you are following Bronx, then obviously you can be using his Bronx box indicator to mark out your London highs and London lows, etc. But for this example, we're just going to focus on what we actually see. Now, these are the main targets, like I said. There are other targets you can have. In this case, the opening 9:30 candle is a very strong source of liquidity because all of the breakout traders, you have to imagine that they're all full porting. So in this case, we had a load of sellers stop price from going any higher, and then we just had this massive sell-off in this session. So this would be our draw of liquidity to the buy side. You can either mark it out with the actual name, which will help when you're doing your chart markups, but technically anything that we need to buy to get to a target of liquidity is why we call it buy side liquidity, because we have to buy to get there. And then sell side, we have to sell to get there. So let's run through what happened on this trade. So we have these clear swing points. And again, this is what I'm saying. Swing points can be on any time frame. So we can even go on the 15-minute to actually just double check what was there, if anything got swept. Well, it turned out we were trading and inversing a bullish fair value gap here. And then we created a new one to the downside. And price is currently still respecting it. So at this general time, this was unmitigated. So once we swept this swing low here, and this is why I said you can go by any 15 swing low or high. It helps if you know if it was a session example or not. The case is proven here. We swept whatever this was after this huge buy up and sell off, and now we've left an unmitigated gap, which is, as you'll see later, one of the strongest draws of liquidity combined with another target. So the reason why this trade was still valid for the lows is we've taken out a lot of buy side liquidity, whatever it is, and we've taken out prominent swing highs. We haven't traded above this gap. We're still respecting it, and we've taken out quite a lot of buy side liquidity. So technically there's no reason to go higher, which helps determine the bias of looking for sells. So if we just go back on the 1 minute, 9:30 happens. If you were trading this in real time, obviously you might be inclined for a sell later on, but now, like say, usually when we have like big sell-offs or dumps, we're bound to at least retrace half of it. Like we may just continue to this level, for example, and then just start trading back down again, which is where the 20-point system for NASDAQ comes into play, because if this little general area is 20 points, but we know there's strong liquidity targets up here, we have all these, actually, well, these aren't unmitigated, but we have an unmitigated set of gaps up here on the 15-minute time frame like we saw. So instead of holding for that and potentially getting stopped out, you know, if we have 20 points and a 20-point stop loss, there's a higher win rate of actually making it. So when I first marked up the chart, literally, I just called it sell side. But when I looked back on the 15-minute, yeah, it happened to be the previous session low, which again is marked here. Previous session, 9:30 to 4 p.m. Eastern Standard Time. 9:30 here. So previous session high is going to be up here clearly, and the session low is there. But again, even if you wasn't focused on what the liquidity is, just using a 15-minute is going to help a lot of the trade ideas. So we'll go back to 1 minute time frame. So now this is the start of our next trade idea to go to the upside. And my liquidity targets have disappeared. So to keep it simple, when the indicator goes off, the reason for the indicator in the first place is just to mark out if I'm not looking at the chart, because this won't call out every play that I would take if I'm on the chart at the time. The benefit of the indicator is that it actually calls out different trades at different times that I might not be looking for. So I'll get alerts for those. So let's just run through this trade before I drag on too much. So again, we've had the context of, we've had a massive push up. We're coming inside of a 15-minute gap, which is still being respected on the 15-minute time frame. And we've taken out a lot of current buy side. So the main draw for liquidity was the session low, because we didn't trade higher. Usually the 9:30 open candle, 97% of the time, one of those will get taken. And if they're both not taken, then it's clear that we're going in the opposite direction. So the high never got taken, the low did, and we still kept going down. So that was another sign that for now, we're not going to go up, because now the strongest draw is this previous session low, and potentially any fair value gaps on the higher time frames below, which now that we're coming into it, we are just waiting first for the sweep. So this is the rule. We want a clear trend to catch the reversal. So we've come down to a prominent session level. Now we want to potentially look for upside. Now, of course, there is a chance that price can just keep coming down. And in that case, we'll look for continuation plays, which is basically, as I showed in the FVG portion, where we're just looking for a fair value gap to be respected. So, like I say, with the context, we aren't trading higher, we want to trade down. Now, on days like this, you don't really need to be looking for an inverse gap first. We can just do the continuation portion, because technically, to make this 15-minute gap in the first place, we have to inverse that 15-minute gap. So just to jump in, this is what I was meaning. So from the previous day, we made a sharp move upwards, made a bullish gap towards whatever liquidity was here. We had the sweep, and then we immediately inversed another 15-minute. And this is currently what has been driving price down for the next trading session, which is here. This is the delivery gap that's taken us to all the liquidity mentioned below. And then what you'll see happen, like I said, because we didn't trade above the opening candle, we just traded lower. We now created a new unmitigated fair value gap, which paired with another strong target of liquidity, which is why I always say target two targets. The opening candle high is right above an unmitigated, and we know that markets like to balance fair value gaps because there's a lot of pending orders in these gaps. So just these two draws alone is why after the sweep, which again, the sweep is confirmed by an inverse fair value gap in the first place, because it's indicating we're changing from the buy side delivery to go to sell side. And then once we've taken everything we need on sell side, the entry model, the inverse fair value gap part one, is going to be our change in the state of delivery once again to the buy side. So any entry trading below is going to be valid, because overall the target is going to be these swing lows and any unmitigated fair value gaps on the 15-minute or higher time frame. Now, the higher time frame could also be the 5-minute if you're trading on a 1 minute. As I was trying to find the trade that I was talking about before, it was actually here. So if we just zoom in, so if we're looking for a continuation play, we're looking for, as I've shown in an example, we want to know which gap is going to be respected, and it's easy to find if you're just patient and wait. Now, we have two fair value gaps here, but based on the model, we have the fourth candle tap into it, then the next candle closed inside, so we would mark out the swing point, the candle low, of the wick, because that's going to be our entry point. But this one closed miles away, and it also took out the swing point. Now you can still take the risk and take the trade, but again, you want to be patient because this could have happened and then we could have just traded continuously back up. So how do you know which gap is going to be respected the most? Like your lady says in the nighttime when she's full of sickness and she's like, do you still respect me? We're just looking for the next gap to be respected. We have 1, 2, 3. We mark out the next candle that goes inside the gap. We mark out the low. We want the candle to close body below this level without taking this swing point. So we just take the next candle. Now, the next candle closed. Now, obviously with liquidity runs, we don't need it to come into the gap. This is still continuing from the gap. So this entry is now our confirmed one. Now, again, I do go by 20 points, but on days where there's like tariff news and stuff like that, if I have to go more than 20 points, I'll either not take the trade or I'll have to downsize to 5 micros and I'll trade the same amount. I'll trade 40 points, which is still $400 on 5 micros. And again, we have our main draw, which was easily hit. So that's your continuation model in action. But the main trade, what you're all here for, is the indicator calling an amazing trade. But I say once you've got this context, it should be a lot easier to know when to take an actual trade based on the indicator. Because again, don't take every single trade because it's reading sweeps off every candle's wick. Where ideally we want to basically be taking a trade only when like a prominent 15-minute gets taken. If this was like 15 minutes, for example. Let's just go back into the trade. So we're just waiting now. So we're anticipating buys because we have strong draws of liquidity. We have unmitigated gaps up here on the 1 minute. And if you have double gaps, then you can just go to the 2 minute and just consolidate if that's possible. Or go on the 3 minute, just go higher and higher. But I only really take entries on up to the 1 minute. Preferably, that's the highest one I'll go to, but 5 minutes at a push if I'm trading gold. Again, let's play out the trade. We've taken the low, so we're just waiting now for gaps to be created. And normally what I look for is I want a gap to be made during the hunt for liquidity and then for that to get inversed. So actually here, before the indicator called the trade, I think we have this gap marked out here. But I actually think this is the one they indicated. Yeah. So this is it. So this is what we're looking for. We want a gap just before a prominent swing low is taken to be inversed, because the inversion of this is determining the change in the state of delivery, which is an ICT term, CISD, because it indicates if we are still delivering to sell side, we shouldn't be inversing to go and look for delivery to the opposite side. But the indicator is doing exactly what the model teaches. So we have a gap that gets inversed, then we have a new gap to the upside, which is in our bias because we're targeting buy side liquidity, which is the opening high. Now you can take the candle entry straight on here, and to have a valid stop loss, we want to make sure we at least got 20 points under the gaps. And again, targeting 20. Now look how small this is. This is why I'm saying you can try hold for big rewards, but if you're just going for a simple 1-to-1, you can risk 3 minis on this and make $1,200 in a couple of minutes, as opposed to hoping that this target gets taken without your stop loss needing to be so big under this swing point, because this should be a protected low. Because again, we've already taken out this prominent low. We're now trading higher. We shouldn't have to come here. And if we came even disrespecting this gap and candles close on the outside, I would probably cut the trade as well to minimize the risk, because I know if that gap now gets inversed, probably more likely going to get traded to the downside. Or we can just wait for a new entry to the upside if it's still in play and our stop loss just wasn't enough. But on average, 20 points to 25 is enough. We're only targeting buy side. So if you want to go by the swing point method, we have our swing high there. We're marking out the previous candle's high. And ideally we want a candle not to do that. But since this is so big and it's relative bigger than the other ones, this is a new displacement candle. So this could be confirmation that momentum is there. So you can still take it from there if you wanted to. And then we'll just play price out. So this is what I'm saying about having valid stop losses. So here is 37 points. So in this case, go to 5 micros, but I'm just running 20 and 20 just to be in and out. And we hit that literally 3 candles later. 1, 2, 3, 4, 5. So that trade's done in 5 minutes. And there's your 20 points. If your stop loss was at this new protected swing low, that's when you can hold for more, trying to get up to here. Now again, there's no guarantee that this is going to get hit, but we just have to watch and see what price wants to do. And this is what I'm saying, you could be waiting a long time for this. So if you want to be in and out of the market, this isn't something you really want to be looking for, because this took 2 hours. You did get quite a lot of points, like 80 points, but 20 points was more easily attainable in this specific instance.